Silver is doing something that should make every investor pause. Not because the price is going up, not because the price is volatile, but because the reasons behind the move are different this time.
By the way, silver $50.54, up 7%. And silver up 35%. By the way, silver is at its highest since January of 1980.
This is an all-time record high for silver. It's eclipsed the peak from 1980. Now, that is the biggest one-year gain since the 1970s.
For most people, silver is that cheap version of gold. Something you trade, something you speculate about, or maybe buy a few coins and forget about. But right now, silver is sitting inside the intersection of global finance, industrial supply chains, geopolitical strategy, and leverage inside the banking system. And when those four forces collide, especially in a relatively small market like silver, you don't get normal price behavior. You get stress fractures. Over the last several months, we've seen volatile price swings, sudden sell-offs after massive rallies, margin requirement hikes, rumors of a major financial institution being under pressure in silver, and quietly one of the most important developments of all, China restricting silver exports. These aren't random events, they are connected. And whether you own silver, you trade commodities, invest in mining stocks, or you just want to understand what's happening beneath the surface in the global markets, this matters. Because silver is no longer just a precious metal, it's becoming a strategic resource. And today, we're going to break all of this down in a way that actually makes sense. Welcome back to the channel where business, money, and investing actually makes sense. Before we dive in, please hit the like button and subscribe for more content like this. Your support really helps the channel grow. All right, let's get into it. Let's start with the obvious question. What is silver actually doing right now? Over the last year, silver has experienced one of the strongest rallies in decades, followed by sharp and fast pullbacks and unusually high day-to-day volatility. This is not normal behavior for silver. Historically, silver moves slower than stocks, it's more volatile than gold, rarely in straight lines. What's different right now is the intensity. Silver didn't just drift higher, it exploded. Corrected volatility, then rebounded, all within compressed timeframes. That kind of movement tells us something important. The market isn't just repricing silver, it's trying to find an equilibrium. And that usually means something structural is changing. To understand what's happening, we have to address a critical concept that most people misunderstand. There are two silver markets. There's a paper market and a physical market. Paper silver includes futures contracts, options, ETFs, and derivatives. Most silver trading volume happens here. With physical silver, this is actual bars, coins, industrial supply, and inventory in vaults. Here's the key point. Paper silver can be expanded infinitely. Physical silver cannot. When stress builds in a system, these two markets can disconnect. Let's address a headline that everyone keeps talking about. A bank was margin called on silver. Here's the truth. There's no public information that a specific bank has failed or defaulted due to silver. But that doesn't mean nothing is happening. Here's what actually happened. Exchanges raised margin requirements on silver futures. Margin is the collateral traders must post to hold leverage positions. When margin goes up, traders must add cash or close positions or reduce exposure. If you are highly leveraged, holding large positions, or operating on thin liquidity, this can become a serious problem very fast. When prices spike, when margins raise, and the liquidity tightens, someone always gets squeezed. If that someone is a hedge fund, a trading desk, or a large financial institution, the market feels it. This is how forced deleveraging happens. Not because someone made a bad call, but because the rules have changed mid-game. Here's the important distinction. A margin call does not mean bankruptcy, insolvency, or a collapse. It means the system is under stress and leverage is being reduced. That alone is enough to create violent moves. Silver is especially sensitive to this kind of event. Why? It's because silver market is relatively small, a large portion of trading is leveraged, and industrial demand is inflexible in the short term. Unlike gold, central banks don't hold silver, there's less price stabilizing demand, and moves are more exaggerated. This means when pressure hits silver, it moves fast and hard. Now let's talk about the most unreported part of the story. China has begun restricting silver exports through licensing requirements and approvals. This is not a headline-grabbing ban. It's far more subtle and far more strategic. What is China actually doing? They are limiting who can export silver, They prioritize domestic use and they are reducing outbound supply. This mirrors what China has done before with rare earth metals, strategic metals, and critical industrial inputs. Why does this matter? China is one of the largest producers, they are one of the largest consumers, and they are one of the most advanced manufacturers. Silver is essential for solar panels, EVs, electronics, high efficiency conductors, and advanced manufacturing. By restricting exports, China ensures domestic industries get first access. Why is China doing this now? Let's break China's motives into 4 buckets. First is industrial security. China wants guaranteed access to silver for renewable energy, grid infrastructure, and technology manufacturing. You don't want to export what you need for growth. Second is strategic leverage. Controlling supply gives bargaining power. This isn't about price alone. This is about dependence. Third is price influence. Restricting supply supports higher global prices. If you hold inventory, that's advantageous. Fourth is they are long-term planning. China plans in decades, not quarters. Silver fits into energy transition, electrification, and industrial dominance. What does this mean for global supply? Silver was already tight. Now, less silver is leaving China. Industrial demand keeps growing and inventories are shrinking. That doesn't cause instant shortages, but it creates fragility, and a fragile system breaks suddenly, not gradually. What should investors keep an eye on moving forward? Physical inventories, exchange margin changes, China policy expansion, industrial demand growth, and paper versus physical price divergence. Silver doesn't need hype, it needs attention. Silver is not behaving irrationally, it's responding to leverage stress, supply control, industrial demand, and strategic competition. This volatility is a message. If this video helped you, hit the like button, subscribe, and share with a friend who needs to know what's going on in the markets. Drop a comment below. I want to know what you think silver does next. I'll see you in the next one.